Everybody. Thanks for joining us today. My name's Tony Barbone. I'm a director and the founder of Private Mortgages Australia, and I'm going to be hosting the session for you. Today's webinar is called Private Lending in 2020. And wow, what a year it has been. One for the record books. We had the bushfires. What a way to start the year, known as Black Summer. A lot of devastation to our wildlife and a lot of businesses and communities that were affected as a result of that. And then when we got through all of that, then we had COVID-19, a worldwide pandemic. So it has been definitely quite a year, and we're going to be talking about that today and how small to medium-sized enterprises have been affected by that, how the lending market has been affected, and how the private lending segment of the market has been affected as well. So let's jump right into it. We've got a bit to cover, and I want to be as close to, want to keep it within 30 minutes. So today's session, we're going to be talking about the results of our 2020 referrer survey. We're going to be talking about the SME funding during COVID-19, some of the changes that we've seen, and we're also going to be talking about the different types of borrowers that we can assist in the current state of affairs of the economy. PMA has implemented some changes to our loan to value ratio policy and pricing policy. So we're going to have a bit more of a discussion about that. And finally, we're going to be talking about the PMA way, how PMA differs from some of the other private lenders that are out there in the marketplace. And I suppose just more about our ethos, how we pride ourselves in operating our business and the types of things that we do. So let's jump right into it. To kick things off, let's talk about the results of our Private Lending 2020 survey. So we recently conducted a survey of our referrer database, and when I say referrers, I'm actually I would say more than 95% of our referrers actually comprise of mortgage brokers. We get the occasional, solicitor, real estate agent, accountant, or bookkeeper that approach us to help out some of their clients that can't get traditional finance. But I would say that definitely the vast majority of our referrer network, it comprises of mortgage brokers. So today, if you hear me talking about a referral or a mortgage broker, I'm just going to use those terms interchangeably, but they do mean the same thing. Okay, so we recently conducted a survey of our referrers, and we had some really interesting results. So we asked the question, why does a referrer choose? What does a referrer look for when selecting a private lender? And these are our top 3 responses. And the first one there was the ability to deliver on their promises. And if you think about it, it really makes sense. Do you want to deal with someone who's unreliable and flaky, or do you want to deal with someone who has a proven track record, and if they issue an offer, it means that they're going to execute on it. They don't issue offers willy-nilly. You want to be dealing with someone that actually has a very good track record. So, at PMA, we pride ourselves for being in business for 6 years now, and we've always delivered on our promises. And as a result of that, we do have lots of referrers that would come back to us and work with us again and again. Okay. So the other big reason for referrers, part of their decision-making process when selecting a private lender is flexibility. So let me just dial it back a bit for you here. So private lending, I look at private lending as basically problem solving. Okay, and the way I look at the lending landscape in Australia is I really sort of lump them all into 2 camps. Okay, so I call it the traditional finance camp, and in there you've got your big banks, your little banks, your credit unions, and your non-banks, and they all fall in the what I call the traditional finance camp. And then we've got the private lending camp, which is sort of everyone else, and that's quite a fragmented camp as well. So when we look at transactions, so we help referrers, clients that can't get traditional finance. Okay, if they've exhausted all of their options there in the traditional finance camp, then they come to us. And that's so we need to be flexible, because We're not dealing with those vanilla clients that are easily going to be able to get finance any day of the week in the traditional camp. We're dealing with unique situations. No two transactions are alike, and there's always some sort of peculiar twist that we have to work through. So that's really why we need to be flexible. Okay, so the other interesting bit of feedback we got from referrers about their decision-making process when selecting a private lender is quick turnaround times, and we see it again and again. A very typical scenario for us is that we see a developer or a property investor. They've purchased a property. It could be on a 3-month, 6-month, or 12-month contract, and they put their deposit down, and they're getting. The bank said, yeah, that's fine. We'll definitely lend you the money on this one. And then it gets a little bit closer to settlement. And all of a sudden, they can't get a response from the bank. And the bank at the very last minute, they've just said, look, something's happened. We've changed our policy. Sorry, we can't help you. So then and there, the borrower and also their referrer, they need a very quick turnaround. They need a quick response. They don't have time to waste. They have to get a solution, usually within about 1 or 2 weeks. And so quick turnaround times are uber important when it comes to dealing with private lenders. And so down from that, we've found that, we asked our referrers, what is a reasonable period of time for a referrer to be able to receive an indicative letter of offer from a private lender? And the magic number seemed to be 2 days. Less than 2 days made a lot of sense. Okay, so if you're dealing with the private, it seems to be when a referrer reaches out to a private lender for a solution for their client that can't get traditional finance, they want a response within 2 days. And I'm very pleased to announce that at PMA, we always deliver within 2 days. Okay, and a lot of the time in much lesser times, but 2 days is sort of the magic number for us that we're setting as a benchmark for now. Now, private lending. So the next point is that we asked our referrers, where do you see private lending in 2020 and beyond? How does it fit into the landscape? And the interesting response we had was that, there's more prevalence now than ever. And the reason for that is that the banks, we're hearing that the banks are retreating. They're lending less. They're being more strict to their borrowers. If you don't fit that perfect vanilla type of pristine client that the banks want, you fall into you fall outside of the traditional finance camp. So that's really, we're seeing our referrers, the referrers that we surveyed, there was a resounding response that said that they see private lending becoming more prevalent as we move into 2020 and beyond. Okay. And one of the other questions we asked was, what is it that, what makes sense to you? How do you want to learn about private lending? And the response was, we want webinars. So thank you all again for joining this webinar. We're going to be doing more of these. It seems to be, a short, sharp and shiny way to get the information across to our referrers that are hungry for it. So we're going to definitely be doing more of these. So let's keep on moving. So the SME lending during coronavirus. A lot of businesses have been affected due to the shutdown. Now, PMA, we're very, very proud to announce that in many ways, PMA, it's still business as usual. And the reason for this is that we've been running a remote office since we set up shop back in 2014. Now, we've still got our head office in Melbourne and our facilities available to us. But for the most part, we've got staff sprinkled all over Australia and some staff sprinkled overseas as well. And the good news is that our operations haven't been affected one bit because of the lockdown, because we've already up and running using that remote type of workplace. Now, a lot of other businesses have had to scramble very quickly to sort of get used to the new normal of using Zoom and Google Chats and Microsoft Teams and all of the other different types of online platforms that allow them to communicate effectively from a remote locations. Fortunately, PMA has been ahead of the curve, as we like to say. And what we're finding is that a lot of the stigma of working from home is really sort of just dissipating now. It's becoming the new normal for people to be able to conduct their conference calls online and over the phone. So again, proud to announce that PMA's operations haven't been affected one bit due to the lockdown. So it is business as usual in many ways. So conversely, now we are seeing finding feedback from our referrers that the banks are stretched. We're hearing from some of our regular referrers that the majors have got very, very long delays. It's taking upwards of 6 weeks in some cases for the banks to even have an assessor look at a transaction. Now, if there's a request for information, good luck. They could be waiting months for a response. So we're seeing that, and a lot of our staff are ex-bankers, and we've heard from them firsthand that the big banks just aren't geared up for this. They sort of work under the old model of having all of their staff in one call center or a centrally located office under oversight of a manager, and a lot of them they're just not used to having their a lot of their operations having to sort of disperse now and work from remote locations due to the lockdown. Fortunately, we are seeing that the lockdown's being lifted in a lot of places. Unfortunately for Victoria, it's back on. So that is posing some additional challenges for businesses out there, and especially banks. So we are seeing the banks. We're seeing a lot of lenders within the traditional finance camp really tightening up their lending criteria as a result of COVID-19. Interestingly, we've also seen quite a lot of private lenders that have stopped lending altogether when in March, when it was announced that COVID was a worldwide pandemic. We saw quite a lot of private lenders just put a freeze on all new lending. And I think a lot of that has to do with the way that those types of private lenders are set up. So a lot of private lenders, if they've gone to the effort of getting an Australian financial services license, and a lot of them don't, they just fly under the radar of ASIC. But if a lot of private lenders are set up using what's called a contributory scheme. Okay, so what that means is that they go off and they send out a letter of offer and they tie up the transaction, and then they go off to their investor base and they lasso their investors to bring them in. The problem with that model is that a lot of their investors, they got the heebie-jeebies when they thought the sky was falling, and they're just as a result, the private lenders put a complete freeze on all new loans. Now, where PMA differs from that is PMA is a fund manager, and we operate a pooled mortgage trust where investors invest for the long term, and then PMA makes the decision on where those funds are invested. So we've been lending right through the coronavirus lockdown period. And I think in the month of March alone, when everything fell off a cliff, we still wrote about $8.5 million for that month. So despite the changing conditions. So it's, it depends on how the private lenders are set up and as to whether or not they're going to still be lending through the changing market conditions. Now, we're seeing some other initiatives from our government to create stimulus in the market. One of them is the instant asset write-off threshold. And so this one has been lifted from $30,000 up to $150,000. And it's going to be available for small and medium-sized businesses to take advantage of this before the end of December this year. And what it does, the idea is to sort of stimulate them to go off and buy new equipment so they can get an instant asset write-off this year. And then they can, of course, reduces their taxes ultimately. The other one of this type of thing that we're seeing is another government's initiative that we're seeing is the home builder grant, which is really, if someone is upgrading their owner-occupied property, or they're going to be building a brand new home that costs more, and if it's the building contract's more than $150,000, then the government's going to chip in another $25,000. That doesn't really affect PMA too much because we're a non-coded lender, so we don't do any consumer lending. But it's just good to know for referrers out there that there are initiatives that are in the marketplace, and it might be a way for them to be able to pivot and help their clients trying to achieve different outcomes. So another point is that as a result of the lockdown, a lot of businesses have got, their cash flow has been affected. A lot of businesses do have lumpy cash flow, and the lockdown has really proven to be quite a problem for us. The way that we look at it at PMA is that if there's available equity, we're still helping borrowers out there, provided they fall within our new loan to value ratio and pricing limits, which we're gonna jump into very shortly. So let's talk about who private lenders help. So if you had to sort of distill it down into three key types of borrowers, we definitely private lenders help property investors, developers, and business owners. So property investors might be someone who's got quite a substantial residential or commercial portfolio. Developers, as you know, they're people that, they're buying land, developing properties and selling them on, and business owners are those that could be any type of business at all. So PMA only provides non-coded finance. We don't provide any consumer finance at all. So these are our three main borrower profiles that we deal with. And then you've got a variety of different situations that crop up. Okay, so you might have a borrower needing urgent finance. Maybe, it's a business owner that needs to buy some stock, but they can get it at a discount because one of their competitors have gone out of business. Or it could be, you get a developer who, is let down by the bank and needs to settle quickly on a property. Otherwise, they're going to lose their deposit money and all of the profit associated with the project. Or it could be a similar thing for a property investor. They've bought a brand new commercial property and they need to settle on it, but the banks they just can't lend because it doesn't make sense to them. So, there's a lot of different types of scenarios that fall within servicing those different borrower profiles. The big differentiator between private lenders and what I call the traditional finance camp is that private lenders like PMA, we don't assess a borrower's serviceability. Okay, we're asset lenders, and we're more interested in the value of the asset, the loan-to-value ratio, and the exit strategy. If we're going to lend money to someone for, say, a 6-month period, we just need to know how they're going to repay it back at the end of the 6 months. Okay, where this is this differs greatly from the traditional finance camp that are more interested in writing a loan for sort of 25, 30 years. Okay, some of the other types of examples we see at the moment are ATO debts. Is very prevalent around May each year when businesses are required to pay their debts, and other more traditional financiers, they won't look at lending money to a borrower if they've still got debt to the ATO. So we deal with these types of situations all the time. Some of the other examples is they're looking for a loan based on the valuation, not the contract price. Or another one is paying out a business partner. We had one recently that we did. It was a management buyout. The general manager of a company, an import company, was purchasing the company from their the boss or the owner of the company. So they had available equity that we were able to provide them the finance. They paid us out over a 12-month period, and now it's happy days. They own the business outright. It's worked out really, really well for them. It's a great transaction. So these are the different types of scenarios that we see, and these are the main borrower profiles that we help. So let's have a look at PMA's new loan-to-value ratio policy. Now, when the federal government announced that around mid-March that the coronavirus is going to be a worldwide pandemic, there was mayhem. Let's face it, everything changed. And so we wanted to be really quick in the way in which we responded to our referrers so that, we didn't want to muck anyone around. So we did make a few changes. So these are the new maximum loan-to-value ratio limits that we have for the different types of property sectors. And here's our interest rates. Okay, so we just wanted to make it very clear that we're still lending. We're still definitely open for business, but the transactions that we're doing have to make sense to us. Especially that we are going through a bit of a transition here, and some of the security properties are fluctuating in value. So we just want to make sure that we're only lending where it makes sense. Okay, so in terms of most of the transactions we're doing at the moment, most of the stuff we're doing is registered first mortgages. We're very selective with the types of registered second mortgages that we do. And we only do second mortgages on a standalone security basis against major metro residential. If it's a bit more of a peculiar type of transaction, we can still do it. It just has to make sense. So if it's a lot of the time we get borrower groups that, they might own a residential home, they've got a commercial property and a couple of investment properties, and they need to access funding really quickly for their business because the business is having some cash flow difficulties due to the lockdown. And so if there's available equity in their entire portfolio, that makes sense. We could do a second mortgage over everything, give them the equity release that they need, and then they can, work out refinancing us in 6 to 12 months' time when things calm down again. So let's have a look at our lending process. So over many years, we've distilled this down to make it as streamlined as possible. So, if you do have a scenario and you just want to spitball an idea with the team member, you can give us a call. That's probably a first starting point. And then once we've had a chat about it, makes sense, at first pass, then we'll ask the referrer to fill out a quick app. So head over to our website and fill out a quick app. So it's nice and easy. The referrer just needs to complete the really high level points of the transaction, pop that into our website, and then from there, our sales team will then receive the quick app, and then it will then complete an indicative letter of offer and send that out within 2 days. So within 2 days, and the indicative letter of offer also includes our assessment fee. Now, our assessment fee is just $550 to $770, depending on the complexity of the transaction. For example, development loans are a little bit more complex than other types of easy standalone security type transactions. So once we've got the indicative letter signed off, in that indicative letter of offer is the privacy declaration. So the borrower doesn't even have to touch it until it reaches until you got an offer. And then once we've got that signed off, we get through our due diligence. We can process our due diligence usually within 2 to 3 days for all of the internal searches that we have to do. But sometimes there are things that are outside of our control, like if we need to get a valuation report or a quantity surveyor report. If there are these types of specialized reports that need to be acquired in order for us to move forward, it works on a flow-through basis in terms of the fee. So we'll go off, we'll get some quotes, we'll send through the quote that we want to use to the borrower, and then they just remit the funds to us, and then we'll pay the value or the quantity surveyor. So it sort of works on a flow-through basis. There's no margin that we make on that. And then once we've got the reports in, we just simply move to letter of offer and settlement. So we've simplified it to make sure that it's really easy for referrers to engage with us, and more importantly, it's really easy for the referrer's client to engage with us as well. Okay. So let's have a talk about a case study now. So it's always good to put things into context with by using an example of a transaction that we did recently. So I guess if we sort of dial it back again, remember we're talking about the two camps. You've got your traditional finance camp, and if a borrower is exhausted all of their options within the traditional finance camp, then come to the private lending camp. Okay, we get people trying to get referrers bringing a client to us, and they say, I want 6%. I can get 6% per annum. It's like, great, take that. We're going to be, private lending is considerably more, but it's not really about the cost of it's not really about the interest rate entirely. It's about the solution. Either it has to make sense for the borrower to proceed. Okay. And so here's an example. So we had an urgent finance situation where the borrower they're developing a retirement village in Lake Macquarie, New South Wales. I think it's about 50 different little, 1 and 2 bedroom type of little apartments, or like units. And then they have the people coming in, and it's like a retirement village setup. Anyway, I won't go into the intricacies of it, but they're very profitable once they get it up and running, but they're notoriously hard to get finance on to construct. Okay. So they approached us and said, look, we have an existing private lender, first and second mortgagee. We've had a jam. Something's gone wrong, and we need to basically pay them money like within a few days. Otherwise, they're going to appoint a receiver. Okay. So, all right, well, we had a look at it. We thought, okay, this is going to take a little while for us to get a quantity surveyor to get out there and assess where the build is up to. Then we're going to get a valuer out there to do the same thing. You guys need it urgently. What other security do you have? And these are a very well-heeled group. And so they said, we actually got a property in Bondi Beach worth $6 million that's unencumbered. That'll do. So we decided to put a first mortgage against that for $2 million, which is very low loan to value ratio. Interest rate of 9.75% per annum, and it's just for 3 months, with 3 monthly extensions. Okay, so we managed to turn this around in 5 days' time. So we got the payment through to the other private lenders that were, needed something very quickly. Otherwise, they were going to pull pulled the trigger on the receiver, which no one wanted it to happen, otherwise they'd lose their project. And so we managed to basically resolve the situation very quickly. And the idea is once they finish off, they will refinance with the bank, but what they want to do is they need to get the project up to a certain point where they've got enough of the units completed, then they can bring in a lender for the long term. So this is just a recent example of a transaction that we did. So fees and charges. So let's look at how referrers can work with us. Okay, so we like to make it nice and simple. So it depends. The approval fee and referrer fees, it's just dependent on the size of the loan. So for the larger loans, we charge less of an approval fee. When we charge the approval fee, it has an allowance for the referrer fee. Now, I just want to make it really clear is that if a borrower comes to us directly, it's going to cost them the same, even if they come or even if they come through a referrer. It's going to cost the borrower the same amount of money in terms of the approval fee. So we use the term channel agnostic. So it doesn't matter if a borrower comes to us directly or they come through us via a referrer, it's always going to cost the borrower the same amount of money, but we have an allowance in the approval fee for the referrer. And we get over 95% of our transactions from our referrers. The reason why we've set up this way is that we don't want there to be any disparity. Okay, we want it to be a very clean, simple, easy to understand fee structure for our borrowers and our referrers. Okay, so as I mentioned earlier when we were looking at our process, the assessment fee is always going to be only between $550 and $770 based on complexity. If you're talking about a standard, 4-bedroom house in suburbia, one company and one director, that's going to cost $550. If it's a more complex transaction, you're developing a few townhouses or something along those lines, it's going to cost a little bit more because it's going to be a bit more work in terms of doing all of our searches. Okay. The legal fees are at cost and they work on a flow-through basis, and it's just based on what the solicitor charges for documenting the loan. The valuation and QS reports always at cost on a flow-through basis. And the other interesting point is that our referrers have the ability to charge a service fee up to 1% of the loan, and that gets paid in addition to the referrer fee. So the way our referrers work with us is they can, as we just touched on, they can either set a service fee, which goes into the indicative letter of offer, or if the referrer has a mandate, then we'll put the mandate amount into the indicative letter of offer. Okay. Now, we also have what's called a subsequent referral fee policy, and this is where let's say a referrer works with us, they introduce a borrower to us, and the referrer gets paid, we do all the work, and then the borrower, we settle the loan with the borrower, and they had a really good experience. So the borrower comes back to us directly and say, yeah, can you do this transaction? We're like, yeah, sure, we will. And then we do all the work, we settle it, and then we call up the referrer and say, here's your referrer fee. So that's something we pride ourselves in doing that. It's really a way for us to say thank you for bringing us the lead in the first instance. It is your client. Yes, we've done all the work, but we still want to acknowledge the referral. So we do implement that subsequent referral fee policy. Another one is that we also have referral rewards programs. If you jump on our website, you'll be able to see the different tiers. It just works on volume. So if you get up to a certain point with us, then you enter into the Platinum Playground, and then it just works on I think it's $100 voucher for every $100,000 worth of loan volume. But you have to sort of work your way up through the tiers to make it into the Platinum Playground. But yeah, jump on our website and check that out. It's pretty cool. I'm mindful of time, so we've gone a little bit over, but we'll end up going a little bit over. So just sort of bear with me. I just really want to get through the PMA way. And if there's any sort of takeaways, it's probably this one. If you can really think about what PMA is all about, it's this slide here. So when we first set up PMA back in 2014, we just wanted to get that model of the private lender and then just sort of flip it on its head. There's some stuff out there in the marketplace we consider unscrupulous. I've heard horror stories of private lenders charging, ridiculous amounts of upfront fees, and then they do some work and nothing ever happens, and then the borrower's pissed off, and so on and so forth. So we just wanted to flip that model on its head. So So this is what we've come up with. So you're always only ever going to have a very low upfront assessment fee, capped at 770, despite a more complex transaction. We have no charging clause in our indicative letter of offer, and we have no cancellation fees in our indicative letter of offer. And this is really important. Now, if we've seen these letters of offer out there from other private lenders. They have an indicative letter of offer. It says rate from say 1% per month, and then they tie up the transaction. They have a charging clause in there in the letter of offer. They go off and they wrangle some investors, and then they instruct their solicitor to prepare the docs, and then the docs go out, and then the interest rate's no longer 1% per annum, it's 4% per annum. Sorry, it's no longer 1% per month, it's 4% per month. Wow, chalk and cheese. What a big difference in expectation. And then the issue with that is that if the borrower withdraws at that point in time, then they're liable for their costs. And then the private lender puts, caveats all over their properties, and they hold their properties to ransom until they get paid. So we just that stuff, it's just yuck. We just don't like that. We call them dirty loans. So we flipped that on its head, where it's very easy to deal with us for yourself and your clients to deal with us directly. And there is no teeth in the indicative letter of offer. Okay. Now, our valuations, they're done it on a flow-through basis in terms of the cost of the valuation report. There's no margin that we add on that. And more importantly, it's done at a reasonable value. There are other private lenders out there that they instruct the valuer to value the property on a forced sale basis. We don't do that because the valuer has to discount the property by 20% in order to come up with the forced sale figure, whereas we use market value or we use mortgage security purposes. Now, it's a really subtle but key thing to remember, is that we do the valuations at a reasonable price point, okay, in terms of the actual valuation figure. The legal fees are done on a flow-through basis. All of our loans come with a component of prepaid or capitalized interest, but they all come with extensions as well. We live in the real world. We understand that sometimes settlements are delayed for whatever reason. So I'll give you an example. Let's say we did a loan for say 6 months. So it's prepaid for 6 months. The borrower doesn't have to service it for 6 months, and then give them say 6 monthly extensions. At the end of the 6-month prepaid term, they go, okay, well, we've had a little bit of a delay. We just need to, we've got a settlement coming up in a couple of weeks' time. Well, yeah, no worries. Just pay 1 month's interest at the lower rate. Just pay that monthly in advance, and we'll give you up to 6 of those extensions. And then, they pay 1 month in advance, and then 2 weeks later, they book in and settle the transaction. So at that time, we rebate the unused interest in the extension payment. Okay. Now, the flip side of that is that, if they borrow money from us for 6 months, and then, at the end of month 5, they repay the loan, then we don't rebate any of that because it's fixed. It's all agreed up front that's the minimum term for that transaction. Okay. A bit like a fixed rate using a fixed term using a bank. The other thing is we have custom built software for faster deal processing times. We have a full-time IT developer that is constantly tweaking our existing internal software. So we're getting it down to a fine art. We are, there's always room for improvement, but we are definitely working on making it as streamlined as possible for our referrers and their clients. Okay, we have a high level of repeat customers. We have definitely lots of referrers that have used us before, and then they like the way that we operate, and so they keep coming back. And we've also got some borrowers as well that especially like developer clients that have engaged us in the past, and they like the way that we operate, so they keep coming back. So we really think that there's a win-win approach to private lending, and we think that we've nailed it. What we're all about is cleaner loans and better results. So we want to make sure that everything's nice and transparent for our referrers and our borrowers, and with the idea to do more and more transactions for the long term. So look, that's it, guys. I really appreciate all of your time and for taking a bit of time out of your day to sit down and have a listen to what we say. Stay tuned for more webinars. We understand that's very important to you. If you keep an eye out for an email, we'll send you through a little attendance record that you can use as a CPD point. So thank you all for joining us, and good luck out there. I hope COVID doesn't get you all down. Okay, thanks everyone. See ya. Bye.